Hey everyone, this is Eric Bahn, one of the co-founders at Hustle Fund, and welcome to today's session, which is called Evolving Your Pitch, Going from Seed to Growth. So at Hustle Fund, we love putting on these sessions that debunk the black box of what VCs are evaluating when it comes to early stage deals. In fact, you can go to our YouTube channel for some of those past sessions. Go to YouTube, just search for Hustle Fund. But that's only part of the education that venture-backed founders need to learn, because at some point you grow, you mature. Over time, your early stage company will turn into a growth stage company. And today we have a special session where we are joined by my friend Taehong Huh, the founder and managing director of GS Futures, which is a multi-stage VC firm, talking about how your pitch also needs to change as your company matures. We'll cover things like story evolution, metrics, and more. Let's take a quick look at this agenda, though. It's pretty chill. We'll briefly introduce ourselves. I have a couple of questions prepared for Tay, and he's here. I'm going to let him introduce himself in just a moment. And if you have any questions, please put them in the Q&A section of this Zoom webinar. You can use chat, but it's going to be very difficult for us to monitor any questions that come in there. Use it to introduce yourself, tell people where you're based. If you want to talk about compliments for my new WAGME Hustle Fund shirts, you're welcome to make those compliments too. And we want to reserve about 30 minutes after my little guided Q&A with Tay at the very top of the hour, 30 minutes of your Q&A, so that hopefully we can answer as many questions as possible. And to do that, we will have our head of business development, Janelle, who's going to be helping us to monitor those questions coming in. And oh, by the way, Hung, our creative director, is here too, producing things in the back end as well today. So thanks to you too. Before we jump into the session and I have to introduce ourselves and get into the questions, I do want to send a very special shout out also to GS Futures. So if you've been following Hustle Fund for a while, we do these educational sessions on a monthly basis. And the only reason we can do it is because we have great sponsor support. And we're so honored to be continuing our work with GS Futures. I wanted to share just a little bit about what they are all about. GS Futures is a multi-stage VC firm investing into seed teams at the seed stage all the way through Series D. This team is a spinoff from the GS Group in Korea, which is a legendary enterprise representing assets in retail, consumer, energy, and much more. GS Futures is actively seeking and investing in great hustlers, accelerating energy transition, climate tech, construction tech, and the future of commerce. Go to their website right now and tell them what you're hustling. I think you're going to really love to partner with them. You can learn more at gsfutures.vc. Okay, so this is basically us, but I want to kind of just jump right into maybe like the first question that I have, which is quite relevant, which is, Tay, first of all, welcome. And can you tell us a little bit more about yourself and maybe more color around GS Futures and your mission too?
Absolutely. Eric, thank you so much for having me. And I love what Hustle Fund's doing. I love all the activities that you're doing to pump insights into founders. So excited to be here. Hopefully I can, there's a phrase or even a word that I say that's helpful to many of the kind audiences here.
I'm confident there'll be a lot of nuggets, man. So absolutely.
Awesome. So my name is Tay. I represent GS Futures, which Eric, I think, did an excellent job of introducing. So GS Futures, we're the US/Europe facing corporate venture arm of GS Group. So GS Group at a very high level, we started off in the 1940s. Two families started LG Group in the 1940s. And then LG Group and the two families expanded the business very, very successfully and very, very complementarily up until 2004. And in 2004, there was an amicable split between the two families into LG and GS. LG, I'm sure everyone here is very familiar with what LG does. GS, we took more the traditional kind of domestic industries. So I would say at a high level, we're in three key industries. The first being in the energy space, with our largest asset being a 50-50 joint venture with Chevron, where we operate one of the largest single-site refineries in the world. Also, we're the number one independent power provider for Korea. So energy is probably our largest asset when it comes to size. And then the second largest asset that we have is in engineering and constructions. And the third is retail and trading, where we operate the number one convenience store chain called GS25. as well as the #1 TV home shopping, and probably the #4, #5 e-commerce channel in Korea as well. So just a little bit about myself before going a little bit more into GS Futures. So my father was with LG Electronics when I was born. And this was a time when LG Electronics was expanding massively globally. So I was born, I think after a couple weeks I was born, I went to Japan for a couple years. Don't remember much about that, unfortunately. And then I moved out to Orange County where I learned, I guess, my first language, which was English as well as Korean. So up until I was about 6, I was raised in Orange County, California. Then I went back to Korea for elementary school. And then from middle school to high school, I spent 3 years in Newcastle, 1 year in Milan, Italy, Milan, and then 2 years in Switzerland before I made my way back to the US, to DC. So, I mean, the reason why I'm bringing this up is I think all those different changes are such a significant part of my character development. I think that opened up that created resiliency, but it helped me adapt to many different circumstances. And that made me flexible in how I think, but also understand that there's different places that have different pros and cons. And we just have to accept that, accept diversity in many different ways. Mm-hmm. So DC, I went to Georgetown and very quickly realized that politics is not an area that I want to be into. So I was either going to look to transfer out, not because the school is bad.
And you were in the School of Foreign Service, right? At Georgetown.
I was in the School of Foreign Service.
Hardcore. Yeah.
Pretty hardcore. But thankfully, there was a really cool major that just popped out called Science, Technology, and International Affairs. And this is when Al Gore and Bush was going at each other. This was when there was bioterrorism going around. This was when the internet bubble just burst. And there was how do we regulate internet, and how do we regulate the up and coming technologies, platforms coming on, like MySpace. I don't think Facebook was there yet. It was just popping up. And that really intrigued me because having spent a lot of years in Europe, Europe is amazing at many things, but even at that time, technological advances in Europe was not there. So I was fascinated to learn about these different technologies and how it intersects with both the private sector as well as the public sector. So after Georgetown, I had to do my military service where I came back to Korea. I worked for a government-backed startup in the energy space, actually, digital energy space, looking at smart grid technology. And after that, I decided to join the online retail side of GS Group called GS Shop, which is now part of GS Retail. Mm-hmm. And the reason why I joined that company was because I understood, as a large incumbent, which started in 1994 as a TV home shopping company, there was a lot of inflection. I mean, it was past its inflection point within the TV home shopping category as well. But also there was competition coming from all over the place, especially up and coming startups, now not a startup anymore, Coupang, and the many different social media commerce players that were coming in. So when I spoke to the CEO of GS Shop, I wanted to do two things: expand geographically, or start investing in venture to equip ourselves with the right tools and weapons to defend ourselves, as well as become a prominent player in the retail space in Korea. And that mission was very, very interesting for me because I didn't spend a lot of time in Korea. All my family is in Korea. I love Korea. I do think Korea will be my home for the rest of my life, despite where I live. So I joined GS Shop wanting to add to that value. So fast forward a couple of years, 2015 to 2017, I was fortunate enough to go to a school nearby in the Bay Area, which has a heavy focus on innovation as well as venture capital. And I went in with the clear mindset of how do I bring a proper venture investment practice into a large corporate like GS Group. And so for 2 years, studying, doing my MBA, I really worked with my friends as well as professors, as well as other investors to try to figure out the right way to do corporate venture capital. because there was a lot of value add that corporates could do, but just because of the nature of corporates, I don't think corporates were weaponizing their advantages as well as they should have been doing. Fast forward a couple of years, at the end of 2019, 10 different business units within GS Group spanning energy, constructions, and retail and trading decided to get together to create GS Futures and its first fund, which we're calling Collect Fund One. So although politically it's a little bit challenging, we become a very interesting partner for the large venture ecosystem, whether it's investors as well as other founders, because we're not only coming in with an energy angle, we're coming in with energy angle, EPC angle, retail and trading consumer angle. So jokingly within ourselves would say GS Group, we have the capability to build smart cities, the next generation of built world that kind of converges the online and the offline capabilities without healthcare. Because healthcare is probably the only space that we don't play in when it comes to the bare necessity of a certain city or dwelling. So GS Futures, we have been positive contributors or negative contributors, however you want to spin it, to climate change. And because we've been culprits over the years, we strongly believe that we hold the key to reversing climate change. So if I were to describe one theme that GS Futures is focusing on right now, it'll be sustainability. So we're looking at climate tech investments. We're looking at energy transition tech investments. We're also looking at future of commerce investments. And fourth, we just spun up another fund that is exclusively focusing on the innovations and sustainability of the built world. So it's just engineering and construction sponsoring this fund that just spun out a month ago. So right now we're going to be looking at innovation in the built world as well, construction tech, but also sustainability materials or as well as energy efficiency of the built world.
Awesome. Tay, thank you so much for that walkthrough. And I think a couple things that are exciting about this. So probably a lot of folks here are new to GS Futures because you guys are a relatively new brand, especially here in the Bay Area. And just want to emphasize that Tay, the reason why I like working with him, and I consider you, Tay, to be like a personal buddy by now, is like,
Absolutely.
Again, like you're like classic like operator turned VC, which is now becoming like a thing. And that's really exciting as a founder to work with someone who understands that. But also GS, like if you're working in one of these industries that Tay has cited, it's a little bit unusual because they're not just someone that can fund you, but could also potentially be a strategic partner in helping you to bring your technology and some of the assets that GS overseas, which is actually, maybe a good transition to one question that we had here, which was, what are some other dynamics for founders to know when they're pitching a corporate like GS? So can we like expand upon that a little bit? Like when you find a founder who's, let's say, working on energy transition, you're like, right in our strike zone, exactly something we see as strategic. What happens next for you?
Good question. And I think that's why you probably describe this as a multi-stage investor.
Yeah.
So corporates, so number one, understand how different corporate CVCs are structured. At a very high level, to generalize things, I think there's three types. The first is balance sheet investors, where the IC process will be a little slower, but they'll
IC being an investor committee process, right? The approval process.
Yes, IC approval process. It'll be the CFOs, some of the key players in the business units, as well as maybe the CEO and new business development folks making the decision. Those balance sheet investors have their own pros and cons, which you should understand. And every corporate will have different characteristics that you definitely should do research on before taking their money. The second type of corporate investors are like us, which are strategic first investors with an independent fund and much more autonomy to take more risks than what business units are typically willing to take. So for us, we're investing in both in three areas when it comes to strategic relevance. First is core. So is this technology that can help our existing core capability right now? And for those, we want to work with companies that are very mature and that can bring immediate value to our companies, or vice versa. We can bring immediate value as a customer to to whatever products and solutions.
And would that be, in that
offering.
case, would that be almost like introducing you to like the corporate head of like a division that could use the technology? Is that sort of how it works?
Absolutely, absolutely. That's how it would work. Obviously, we we're very careful not to force our startups to work with our business units.
Sure.
And we have to be very careful not to force our business units to work with our startups. But we definitely do want to lay that bridge.
Yeah.
And we want to be the internal champions of saying why we chose this company, why we think this is the best company for us. Not in terms of the trajectory of the company in the global stage, but because for us, a key lens that we look into is also the synergy risk or synergy factor when we're looking at deals. So that process can happen during the due diligence, where if we want to see if our business units would be interested in piloting this even before we make the decision. So we kind of have the business units loosely involved in our decision-making process, but we don't need to get approval to make that process happen.
I see.
So that's the strategic first investors, and the third corporate investors are like the Google Ventures of the world, where they're leveraging their existing competitive advantage that comes from Alphabet for deal flow management as well as due diligence, but they are a financial first investor with a clear Chinese wall between the business units and the startups that they invest in. So when you're talking to corporates, I would one of the biggest question marks that I've experienced from founders as well as other corporates and other investors is churn. Many corporates, especially balance sheet investors, the role within the company can shift quite significantly and very quickly. And once you lose the sponsor within a corporate venture, it can be a little tough. So understand, I would do research on how that team is structured, how that team is incentivized, how the IC process works, and how ask for successful case stories of how that corporate worked with startups.
Yeah.
And see if that's the right fit with you, because it's a double-edged sword. And you do want to be careful. So as much as investors are looking for the right fit, the founders should be looking for the right fit when you're looking for institutional or corporate investors.
Yeah, and this is very exciting because like corporate venture, I think plays a much bigger part in Asia already. Like it's a very, very reputable source of capital. In the United States, I think it hasn't been historically the case until relatively recently, where some larger firms have spun up VC firms that have been really great. GS is a good example. Stripe is now doing this. There's a number that do. I actually want to back off a little bit and start to talk about the seed and growth mechanics a bit. And maybe the transition for this, Tay, is to talk about why is it that you structured your fund to cover the scope of seed all the way through late stage growth deals? I mean, just sitting here in my garage in my WAGMI shirt, doing like seed investments, like it's a very, very specific kind of skill set I feel like that our team has in identifying companies and supporting them. And like at the growth stages, like it really evolves. Can you tell us a little bit more about like how do you like do that kind of coverage, and like what are sort of the different kinds of skills that you need to handle those kinds of different types of deals, see through growth?
Great question. So I think a couple of reasons why we are a multi-stage fund. The first reason is I guess by design. 3 areas when it comes to strategic relevance. Number 1, core. Number 2, adjacent. And number 3, beyond. And what I mean by that is this technology, can this technology be utilized by our business units right away to increase the efficiency of our existing capabilities? So for those, like I said, we want to be working with more mature late stage companies where our business units will come in and do both deep technical due diligence as well as market diligence to work with that company right away. When it comes to adjacent, we want to look at value chains that is adjacent to our core competency or new business models that's coming up from new business models or changes that's happening in the world. For example, when it comes to electrification of mobility, a space like EV charging, as well as battery recycling, is an adjacent business model for us, because that's a space that we traditionally haven't been. There's a need for that new business. We want to get into that. So for those, we would probably be looking at Series A, Series B companies. And then there's the beyond investments, which we think is probably 5, 10, 15 years out, but we definitely do want to take a look into that. It might not have strategic relevance for us within the next 5 years, but is it a new business that we want to get into completely as a new source of revenue model, or do we think our businesses will have some relevancy into that area?
Yeah.
So an example of beyond tech for us would be space tech. It would be computational biomedicine. Some areas that we're not in that's evolving, and for those, because we don't want to put massive amounts of checks, so we'll look at earlier stage companies.
Yeah.
As well. So that's one reason. The second reason is because we're looking at both software innovations as well as climate tech, energy tech investments. A seed stage company for example, that's trying to tackle carbon capture will look very different from a seed stage company that's trying to do personalization on digital marketing.
Yeah.
So we wanted to have flexibility in where we can invest. And because we're the LPs and GPs here, we're on the same team, we just wanted to open up the room for that flexibility as well. So in that way, we didn't want to confine ourselves into, we're going to only invest in or put our first checks into companies of valuation between this or stages. We understand, for example, a climate tech company at Series D might still have very little revenue with massive massive upside trajectories, but we want to be looking at those deals as well.
Yeah. Okay. Well, let's move to like a compare and contrast question here, and I'll try to answer like the first part. So let's compare a seed deal on the types of metrics, things that you care about in assessing an investment there versus like let's call it a Series D, like really ups ends of spectrum. So for me, at least as a seed investor, I'm like, this is largely a bet on the team. So do we think that this is a team that has great potential to build something great? It's also very market driven too, which is like, do we think this is a large enough market that can serve a huge outcome? So it's very different if you have like a niche business with a great founder in like cat grooming for short hair cats or something. Like you might be the best founder in the world and taking over that market, but it's gonna be too small to be venture backable in our mind versus something that is maybe in insurance or energy, which has like almost like infinite total addressable market. So a lot less data and much more team oriented. Let's compare that with like a Series D deal. Like, what is the information that you're often asking? Do you have like a set of metrics that you consistently care about? Let's begin with that.
Yes. So before I answer that question, I want to say we have done Series D deals, but those were Series D deals that had the letter D, but it probably should have been a Series B deal. Sure. Because we all understand timing is very, very important. And for some of these technologies, they were probably a little too early. So they didn't get the right traction at the right time. But right now, obviously, with the convergence of different factors, whether it's technology, regulations, consumer sentiments, as well as board pressures, now the timing is right. So, but anyways, one of the key differences, team is always the most important thing, even at late stage. But what you're looking for is probably different, because at seed stage, what the startup is trying to do is trying to validate or prove the value hypothesis. Going from 0 to 1, I understand I have the right insight about a pain point, and I am trying to solve this in a very smart way, and I can get to that first customer. So the skill set required to either hedge the technical risk or the market risk, it'll be about, I have found the right product market fit or that value hypothesis.
Yeah.
Whereas when you start going to the growth stage, your value hypothesis has been proven. Right now, it's about scaling the business as well as your team. And also one key thing is now you're moving away from being the hunter to being the hunted. So there's actually different types of skill sets that you're looking for a team. I always believe that the founding CEO, as much as he or she can carry the company should be carrying the company. But I think he or she should also be self-aware that her skill set that helped her prove the value hypothesis early on might not necessarily be the right skill set to scale the company to that venture-like returns that investors are looking into. So when it comes to metrics, so the way that we do deals is we typically, because of the conflicts of interest issues, we typically don't like to lead rounds. We typically don't like to take board seats. So for us, it's very important that we partner with great credible investors like yourselves, who would be taking care of the more traditional metrics. You could very easily search on Medium for all the different types of metrics. But a couple things that I look for in the seed is, number one, especially because we're looking at hard to solve deep tech problems in climate tech and energy transition tech, is how genuine are you in solving this problem? Because there's going to be so many different ups and downs, both in terms of the market as well as regulation. So are you very sincere about this? When shit hits the fan, can you actually break the wall? Can you break concrete walls, wood walls? Can you figure out ways to navigate this? When it comes to growth stage, the similar hustle is required, but it's much more on the people management skills. One thing that I love to see, just because of the nature of our syndicate process, I would love to see the founder. Does the founder have the right marketing, sales, business acumen to continue to raise from credible investors and put this into the market with integrity? Because integrity is also something that's very important. So that yes. Yeah. And when it comes to metrics, data room, the growth stage data rooms will obviously be much more filled with tangible data points. And those, to be honest, when it comes to the Series D deals, we at GS Futures don't actually lead those deals. We actually toss it over to our business units. Yeah, we'll have more M&A growth stage investment expertise, where they would typically go through a lot of series of financial engineering, but also a lot of feasibility studies internally to figure out, can we use this technology? And if so, how can we use it?
So in those, I want to kind of dig into that, because that was my next question, which is around data rooms. So at seed stage, I hardly ever see them. And if they're there, I'm kind of like, how accurate are these going to be? It's so early. But when you're passing around the data room for a growth stage deal to some of your colleagues in these divisions, is there some consistency of what you're finding? I assume there's like historical financial performance as part of it, team, like org chart. What other things might our founders who are listening today want to look out for if they're getting to that stage?
So this is my personal preference. Please. I mean, obviously there's the basic requirements, due diligence checklist, entity of formation, legal docs, customer agreements, financial projections, obviously the vision, technology assessment, customer pipelines. Those are all things that I think are very regulars in most of the data rooms. Yeah. One thing I love about data rooms, or a tip about data rooms, is fundraising, as a lot of the audiences here would know, it's very time consuming, it's very distracting, and it's very, very, it can be very demoralizing as well. What you want to do is put up many of the work up front. And what I mean by that is, my favorite data room recently was a data room that was on Notion. The founder and the founding team basically put down proses, just explaining in words how they do things. They would also upload customer testimonials as well as customer interviews from independent folks, because when investors are doing due diligence, one of the things that is uncomfortable from both sides is customer due diligence calls. Yeah. Because if I'm not sure if he or she will lead the deal, I don't really want to bug my customer, my valuable customer, to talk to him for 15, 20 minutes. Yeah. But it's also a necessary step, whether you're a small check into it or not, that you want to talk to the customers. So as much as the information you can put on the data room that is easily presentable and readable, I think that's very, very helpful. Also note that the first crack at data room will be done by probably a junior member of the VC firm, who basically will not be able to, who might not have enough experience yet to be able to very quickly identify whether this is an interesting opportunity or not.
Yeah.
So in that way, the decks are very important for concise, but sometimes a lot gets lost without a pitch. So even putting up like a 10-minute pitch on your data room, that's very, very helpful. One other thing is, as you talk to more investors, you're gonna keep getting the similar questions. Just archive those, create a DDQ list or FAQ list. You can put that on the data room, but if you don't want to do that, just have that in the back pocket so that you can send it whenever people ask questions, because many of you don't want to be wasting 30 minutes of your time answering questions that you answered 30 minutes ago. So be diligent upfront when preparing your data room. The more you can do it, the more scalable you can do it. Have that method.
That's awesome. So I hope people were taking notes about Tae's response here, because it's super killer. I'll augment for one thing here, which is, you can just you should think about continuously just adding to your data room, even if you're not raising, right? Like sometimes you might close a great client, Tae, and it's like so much momentum behind it. And Tae's like, yo, like, can I help you in any way right now? Like or in the future, you should just immediately say like, yo, is that right if I just record you for 5 minutes right now, just talking about why you're excited about this? And then, when you're done, snip it down, dump it into your data room. Notion's great because they can become very interactive. You can like embed videos, so it just feels like this nice linear flow where you don't have to click around. But I think the other case for why you should consider continuously updating your data room, even when you're not in process, is funds sometimes will come by and preempt you. Like Tae might just be like, yo, I am so impressed. I know you're not raising right now, but what if I offered you an additional $5 million right now, like an extension on like your last raise? This stuff happens, right? And if you are super buttoned up, it's like, no problem. Why don't you take a look at our diligence materials from, it's up to date. Then you're making Tae's life super easy. And I guarantee you, like, at the end of the day, we're all people here, right? So like, if you just feel like, wow, this person's so organized or just like has their shit together, just like even that feeling, it already biases, I think, investors like us towards like, this seems like someone I'd want to work with for many years. So this is great. Tae, so many great nuggets here. Thank you so much for these guided questions. And what we wanted to do now was actually transition it to opening it up to our audience here. So if you have a question based on some of the things that we shared, talking about, the differences between seed and growth stage, fundraising, questions about also, what it's like to pitch maybe a strategic or a CVC versus like a traditional fund, now's a great time to pump your questions into the Q&A section. And I'd love to actually invite up our colleague, Janelle. Janelle, I'm not sure if, what are you seeing in terms of the activity with the Q&A? Anything good in there so far? I'm sure there is.
Lots of fabulous questions. Thanks for the conversation so far, you guys. I'm going to take this first question that just came in because it's what you were just talking about. You talked, Eric, about how you should always keep adding to your data room. What are other examples? You mentioned a video. What are some other examples of items that you might add to your data room? And how does that evolve over the course of your growth?
I'm going to send that over to my colleague, Tae, here, because he sees a lot more data rooms than I do, I think.
So I would probably say the customer traction at this point is probably the most important thing. So the customer pipelines, if you can keep consistently updated, and there's so many tools out there that you can basically sync your internal customer data pipeline with what's happening on data room. So always think about, this is what Hustle Fund, what Eric taught me when I was first starting Futures, try to automate as much of the back end as possible. So that you reduce the work and keep everything pretty much up to sync. The number one thing at early stage is probably going to be customer pipeline. So what's happening, just put it transparently out there. So I would probably just sync up your Airtable or Excel, Google Sheets that you're using. Well, actually, maybe not. I would have two tabs. One that is that is more internal use, but that also kind of syncs with a more public Airtable or a Google Sheets that automatically syncs into that. So I think that would be number one. Also, financial projections. I'm not really sure what kind of accounting tool that you guys are using, but there's so many great tools out there where you can just basically keep syncing this up. Although financial projections are not that important in early stage, or some people might not see it, but at least from a checklist standpoint, it's probably one of the more burdensome things that you can do. And just automating that, I think, is very, very helpful. Also, I found it useful because at an early stage startup, you do go through pivots, and pivots are nothing to be embarrassed about. Pivots, I prefer flexible, coachable founders that is willing to pivot if it makes sense. So if you have different iterations of your business model that you had, like seeing an older deck that you had last year on that can also be helpful in understanding that, because at this stage, like Eric said, we're basically investing in teams.
Yeah.
So when we're investing in teams, I want to be able to understand how he or she or the team thinks transparently. So I really appreciate transparency, even if it's a crappy deck from 2 years ago. I want to see how your thinking evolved and how much better you got, because that can actually provide me different data points there as well.
Yeah. I want to add two things to what Tay said, augmenting one, which is the automation of like customer pipeline, like any sort of relevant data there. What we do at Hustle Fund when we fundraise is, Airtable is a very big part of how we control our data. So Airtable is amazing because you can actually create password protected views. So if Tay were like considering investment, like we can actually expose like what our current portfolio looks like, some metrics and so forth. And it's like password protected and quite safe to pass to his team. So it's a really neat kind of cheat code. And I actually feel even more confidence of how you can share on Airtable and the options, more so than even sharing like a Google Doc or a Sheet or Drive kind of file. That's part one. I also want to augment something that Tay mentioned earlier, which is, he very quickly cited that like in a data room, you want to be buttoned up on things like your entity formation and things like that. When I became a VC, or right before I became a VC, I don't think I really appreciated how important that is. One of the more heartbreaking things that happens, and maybe it's like once every 2 years, is like, all right, we found the founder Tay, he looks incredible. Let's make him an offer. I'm going to offer him. He takes it. And then like, as we're signing the documents, I realize it's an LLC and not a Delaware C Corp. And like a little bit of like a horror moment will happen. So there's no problem with LLCs in theory, but as a venture capitalist, it's enormously problematic. There's a really crazy complications when it comes to taxes every year when you're investing in an LLC versus a traditional Delaware C Corp here in the United States. So I've gotten much more careful about asking for things like the entity formation, showing that you have the registration with your Delaware C Corp and so forth in order to proceed with the investment, because it is like such an awkward conversation where like, this team looks great, but the entity is absolutely wrong for us to invest in. Very minor side point. I think most of you are pretty savvy about that. Janelle, do we have some, it sounds like looks like we have some more questions rolling in right now.
Oh yeah, tons of great questions. And you guys are hitting all of the hot topics of what our founders in the audience are asking. I want to go back to this idea of team, because Tay, when you said that team is one of the metrics that you look at, even at late stages, it seemed like the audience really reacted to that. So this question comes from Alex. What are the things you pay attention to when you decide if a founder's team is formed properly at the early stage? And then what expertise do you expect to be covered at the seed stage?
Great question. And I think it really depends. So it depends on the, okay, let's see. So at seed stage, like I said, I think I kept mentioning the term transparency. We all understand the team is not going to be complete, but number one, if it's a multi-founding team, I want to see the dynamics between the different founders. I want to see, are they very similar people? Is it 3 exact same people that's just basically bring in the same value add to the company, or is it three people that has complementary skill sets that's bringing in that makes the team a little bit more holistic, especially when it comes to some of the deep tech investments that we look at in climate tech. We definitely want a really strong technical founder that is dealing with the science. But in many cases, those scientists, I mean, right now there's amazing interdisciplinary founders that's basically accelerating all changes to the world. But sometimes many of the smart engineers or scientists aren't necessarily the greatest business people or salespeople. So we want to see those mixes. But even if the team is lacking a lot of the skill sets or expertise, I want to see good self-awareness to figure out, I need this money, I need this financing in order to add these pieces of things to complete my team. So I don't think there's one clear metric that I keep looking at, but one thing I think Eric and myself would probably agree to is, if you're an asshole, we probably won't. I don't like backing assholes. If there's a clear thing there, because many of the visionary, very ambitious folks do come across as assholes, but there are some people who are very straightforwardly difficult to work with. So in a way, in many cases, the best technology doesn't work. The best technology doesn't win in the end. The best businesses don't necessarily win in the end. It's a combination of things. So when an investor is looking to fund your company, they're also looking for, is this founding team a good fit with us? So what teams are looking for, what investors are looking for teams might look very, very differently. I'm not sure if this was a satisfactory answer, but that's how I think about it. So that data room preparation, how you interact during calls, how you answer questions between the different founding team members, those are all subtle cues that I think investors really quickly pick up on.
Yeah, I think that's such a great response, Tay. And I do want to highlight that no assholes thing. Like, I don't think a lot of people appreciate enough that we're, as people, we just like hanging out with people that we like, just like first and foremost. And if you're going to be taking investment from a VC like Tay or myself, there's a high likelihood we'll be spending years together to try to make our company successful. But even more so, it's also quite likely that you as a founder may want to start another company, because most founders just like creating companies. So that could be like decades of collaboration if things work out well. And when it's just kind of just joyful to just hang out, even when you're talking about business or not with a founder, that actually like has a lot in terms of building like that kind of like connective tissue to make it through some of the hard times together and celebrate the good times. So yeah, it's everyone I guess has their own definition of an asshole, but I think Tay, you kind of started hinted at, I think a common one that you and I share, which is if you're kind of like dodgy about like, telling the truth or that, and I understand that feedback sometimes of just like, I don't want to like share bad news with my investor. We'd rather just hear it. Just like tell us what the gaps are so we can help you fix it. Right. And it's not going to scare us away. We're not going to ask for our money back. Like we want to help you fix it. Right. So just wanted to augment that too. Janelle, I see some more questions popping in here. Maybe we can take some more.
Yes, indeed. Okay. So a legal question, and this one's going to go to Tay. So, do you ever experience, Tay, founders' discomfort with the idea around the legal challenges of being invested in by a conglomerate? And can you talk to that a bit?
Yes, it's a very slippery line. You have to be careful. So like I said, do the research on the investment team and how that investment team interacts with the business units. Because one thing you definitely want to avoid is early on in your company, basically giving away your secret sauce of what you're doing very early on to a conglomerate, especially a conglomerate that's not competing in your geography so someone like us in certain ways. So really try to understand what that team is trying to do when they're asking questions. Also, I know that typical institutional investors will not sign NDAs because NDAs create a lot of difficulties. But if you're working on a technology and your key kind of value proposition is based on your IP, I would always try to sign an NDA, and that NDA can be comprehensive, but comprehensive to certain members of the corporate looking into it. But I would always try to put that mechanism in there if possible. And if the corporate walks away and says, I don't sign NDAs, maybe that's not the right fit. Because basically what the corporate is indirectly saying is, whatever you're sending me, I am sharing it with my business units. But the NDA would legally stop that happening. Also, when you're raising money from corporates at a very early stage, be careful not to give away a lot of your upside to, or don't stint your upside growth. One of the reasons why we don't take board seats is we understand down the line there might be a conflict of interest of what is good for the startup versus what's good for GS. For example, if I sit on the board of a company that wants to sell to us as well as LG, SK, my job is to make sure that I make those introductions. But that there's a conflict of interest there. So early on, be careful when you're doing legal DD on some of the term sheets or some of the terms that a corporate is giving you, because there might be some subtle predatory terms where they ask for exclusivity in certain regions, where they want to have some say in your management. Later on in your company, when you're trying to go for scale and distribution partners, absolutely work with corporates there, but be very, very careful in giving up some of the rights early on in your company. And I apologize to some of the corporates out there, including GS, who might not like my response.
I love it. Again, like this is pure 100% Tay, right? You're kind of negotiating against yourself here, but this is, I mean, looking out for the founders. I think that's realness. So thanks for sharing that.
Right.
Yeah, Janelle, do we got some more coming in?
That leads perfectly into the next question. So Tay, you mentioned due diligence, and it sounds like this involves a lot of reading the fine print, looking for something like you said, exclusivity in regions, but it's also a term that's thrown around a lot. So can you guys talk a little bit about what does due diligence really mean to founders, and maybe address it at that pre-seed stage versus seed and growth beyond?
Sure. I can go first, Tay, and I'd love to hear your response. So
absolutely.
Again, a lot of times, this is like the scenario of how we engage with founders. It's, a team of maybe 2 co-founders, perhaps, no employees yet. And they have a pitch deck on the vision that they have. They have some experiences maybe that they can also draw upon, hopefully from relevant spaces, and maybe an early prototype. And the company's just been formed, right? I just went full time on this thing. That's a very, very classic kind of pattern, I guess, that we see in terms of the stage that we're investing. And usually, if there have been previous investors, it could be family members. It could be usually more angels, and rarely like a lot of VC funds that are participating at this stage. So due diligence is tough in the sense that, again, like you're kind of operating within this world where you have a lack of information. Now, there's a few things that we do when it comes to DD. So Hustle Fund's actually kind of like a poor example of this. Like our entire process for how we invest is just unusual. We will start with a very fast check if we're curious about your team with very little due diligence. And then the due diligence happens after, which is we'll then work together on growth projects related to sales or user acquisition. We want to have a period of time of working together with you to get a sense of how well you operate, your hustle, learn more about your market, but also give you a chance as founders to assess us to see if we're like actually adding any value, if we're good human beings and so forth, and good partners. And then as from that, where we make a decision of like, maybe what we love, Tay, like let's offer him like more money, $250,000, $500,000, what have you. And we'll concentrate 2 more checks usually into that given business. So for us, like due diligence is let's work together and see how it is working together, understand your operating and so forth. There are some rare cases where we'll jump to a larger check. And that's if we feel like this is a team that has such extensive track record in this space that and like their track record in itself would be like such a differentiator and moat in allowing them to be successful. Let me give you an example of this. Like we have never invested in a company like this, but let's pretend that there was a founder who's like, I'm going to create a new CRM software that competes with Salesforce. And then the first thing I think about is like, oh no, right? Like this is like, this is not going to work. Like there's CRMs are boring and whatever, and Salesforce owns the space. But then the founder is like, no, Eric, before you like shut the door in my face. I spent 25 years as like the senior vice president of sales at Salesforce, right? And I am just, my entire sales strategy is to go to these people whom I've been working with for 2.5 decades and tell them to just switch over to my software because I'm offering something better, right? And in that case, I would probably invest in this like magical scenario because it's just like this person has like a crazy amount of credibility in this space and track record, but B, all of the context to like get to like $1 billion in sales just by virtue of just being in this industry for a very, very long time. In those cases, I'm just like, I don't even care how competitive Salesforce is. Like they have such strong distribution and trust with the clients already, even before they build a damn thing. So like, to me, that's like a dream scenario of like a pre-seed founder, but it almost never happens. And that's fine. Like you want to take bets on teams that are contrarian and that's how you make a lot of money too in this space. So that's an unusual kind of lens from Hustle Fund, but Tay, I'm sure you have like a different set of rubrics that you care about when you're considering pre-seed deals as well.
Absolutely. Yeah. Hustle Fund's due diligence. You should put DO as due, because you're actually doing due diligence by literally doing it. I think that's a really, really smart way to do things, especially for pre-seed. We don't have that mechanism. We probably don't do pre-seed because we do want to have a working prototype before we start assessing the investment fits. So due diligence for us, it really depends on the type of company, but in any seed stage company, there's 99 reasons to say no. What investors are looking for is that one critical success factor. So that can be the team, as Eric mentioned, or it can be different types of the team. What is the network? What unfair advantage is this team coming in with? It can be an IP. It can be a unique insight that no one has really thought about. For example, Snapchat. It can be many different things. So this is what when we try to do due diligence, especially for early stage startups, is we need to focus on the relevant information. We all know that we're working with incomplete information. Focus on why this is interesting, that critical success factor. And if you agree with that, and if you can help augment that critical success factor. So due diligence can come in many forms. It can be one pager. It can be just an introduction. But in many cases, when it comes to early stage, I do like to speak to maybe 2 or 3 ex-colleagues or friends or investors, just to vet this team, that just the integrity of that team. So even if I don't do any due diligence work, I'd love to ask for at least 1 or 2 reference calls.
I want to share like a very quick story that Tay just sort of triggered, and I know we have maybe time for 1 or 2 more questions after this. So this is an extreme version of due diligence that I've done before, which is, especially I did this when I was recruiting key people on my team back in the day as a founder. So what I would insist is actually we do a family day at the park where you can meet my wife, my kids, and then I would insist that you can bring, your partner, your kids if you have any, your dogs, whatever. And it would be a Korean barbecue in a park near my house. Right. So I bring all the food and all that stuff. And what we were trying to look for was actually how that person whom we were thinking about hiring interacts with their own family. Because we think that this is a very telling thing. And we did this, I remember once with a certain person. And this person is great, but when we saw this person interacting with this person, I'm not going to name genders or anything, with this person's life partner and kids, we did not like what we saw. It was like a really negative interaction. I was like, oh my gosh, you're treating your kids like garbage right now. And the conclusion to that was we have to pass on working with this person. The reason why was if you're going to treat the people who are most important to you poorly, what if we get into a situation where we disagree and have to argue about something, right? There's no emotional safety there. Like it's going to turn into like a really like train wreck of a relationship over time. So it's extreme. You can't do this really at scale, but something to think about, which is like this park thing. So if I invite you to a park for Korean barbecue, I just gave away all my trade secrets here. You know what's coming up. Be on your best behavior, right? To your dogs and kids. So Janelle, maybe we have time for one more question.
Okay, one more. I'm going to give you the top question. Okay, here's to both of you. The top 3 questions you ask when a founder finishes their pitch.
Ooh.
Tay, do you need time to think about it? Do you want me to go first? You want to go first?
I can go on the fly. Number one, many of the investors with 100x my experience would have heard some sort of a similar pitch or a similar business model.
Yeah.
Why now? Why are you working on this problem? And I think those are the 2 critical ones.
Yeah.
I'll think about the third one while Eric gives his top 3.
Oh man, what a cheater. No, I'm just kidding. No, I'll give you some time. Okay, I got a few. The first is the most important question, which is what happens if things go right? Right? Like lay it out for me, like the next 10 years, like everything worked out well. What do you think this world actually looks like? And this is the reason why I love this job and why I love seed investing is it's not as an exercise of trying to like shit on everything that you see. Yeah, there's some of that, but the temptation is to actually reduce that. You want to reduce that temptation, actually be in the optimistic lens of seeing whether you can buy into the vision with the founder. So what happens if things go right, I think is a big one. The second one is maybe a negative, which is like, what is going to kill this business, right? Like, and part of this is actually a bit of an emotional intelligence question that Tay was alluding to, which is, are you self-aware to know where your gaps are or what you need to learn in order to accomplish the vision? And the worst answer is like absolutely nothing, right? Like I don't like that kind of super macho thing of like we are perfect, like because it's absolutely not true, right? So I think that's the second one as well. And then now I'm going to pass it back to Tay because I only have 2, so maybe he's thought of his third, and then I could think of my third as well. Tay, have you come up with your third one?
A third one. I didn't. I was just enjoying your answer.
Sure.
So I said, why now? Why are you trying to solve this problem? And I probably would ask, what are you missing? Or as a corporate investor, I would probably ask, how can I add value to your company at this stage of your company?
Yeah.
I think when we're doing deals together, I think I ask that to the founders as well.
Oh yes.
Because sometimes I need to figure out a way to add value to that company, or else I'm just another dumb money in a syndicate. So I also want to see why the founder wants to take money from a corporate venture capital like GS at this point of their company. So that's a key question for me as well.
Awesome. Thank you for that. And thanks for buying me time, because I think I have my last comment on what the third thing I like to ask. And I do ask this actually in most pitches when I want to invest, which is, do you want to grow old with me? And so, by the way, that's how I proposed my wife. I didn't say like, do you want to marry me? I said, do you want to grow old with me? And she actually said yes. Right. So that's kind of crazy. So the reason why I like to ask that is just like, first of all, it puts you on your heels. Because like, why would you like say such a personal thing like that? But the second, it's kind of fun to see people squirm sometimes. I'm a bit of a troll, right? I do it in a very loving way. But the second thing is, it's also just a reminder of, because we're investing so early, you got to deal with me for a long time. And if there's anything that I shared with you during like our interactions that was even like a slightly negative signal, it's something to think about, because like the things compound over time in our relationship. Like something that might be mildly annoying to you could become insufferable by year 7, right? Hopefully that's not the case, and I'm not too annoying to you, but early on, like starting a company, getting investors at the pre-seed stage, it's like a very emotional process. I'd argue like right before your IPO, when like Goldman Sachs is offering you like $1 gazillion to fund you right before, like who cares if you don't like that person, right? It's just like, you guys, it's a transaction. You're taking the money, you're going to IPO next year. Very, very different. You don't need to like those people, I'd argue. Ideally you do. So do you want to grow old with me? And I think I see two people in front of me, Tay and Janelle, who have expressed the answer as being yes at different times in their own way, maybe through nonverbal communications, a wink here and there. But yes. Well, I know that we are at time here. Tay, thank you so much for jumping on and having this fun discussion and answering some questions with us today.
Absolutely. Thank you so much for having me. And thank you so much, everyone, for bearing through us as well.
Awesome. Well, just a reminder that, if you want to see some of our past videos, we're going to record this session, upload it. You can search on Hustle Fund on YouTube, but a huge shout to GS Futures. Again, so you've met today the founder of GS Futures, Tay. You got a sense of like the cool guy that he is. This is why he's my buddy. Check out gsfutures.vc. They're really, really fun to collaborate with. And thank you all so much for your time today. Wishing everyone a safe rest of your 2022. We'll have more of these sessions, so you'll see my face every month. But thanks again, Tay. Really great to have you here today.
Thank you so much, everyone. Stay safe out there.
All right. Peace out. Bye-bye.